and something must be wrong. Something must be wrong about our theory, maybe our tools. So in order to try to generate just a little bit more inflation, we did adopt a target. And then in 2022, actually, this is wrong too. This was technically 2020. This was changed. Things have changed dramatically. Wait, am I right? Yeah, 2020. The committee judged that we want to have well-anchored inflationary expectations that average 2% over time. So we mentioned the NBU has 5% plus or minus. The Fed doesn't do that exactly. The Fed says 2%, an average of 2% over time. And they don't say what we mean by time. So it could be average over 5 years. It could be average over 10 years. They leave that open. But this is an important change to their policy stance. The public, I don't think the average person in the United States knows any of this. The average person in the US doesn't pay attention, probably doesn't actually know what the Fed even does, really. So you and I are smarter than the average person in the United States already, of course. We probably knew that. All right. So I'm going to tackle some of those challenges to inflation targeting. It seems very obvious, right? Money's related to prices. So if you control the money supply, through interest rates, we'll control prices. Of course, it's not easy. And there are all kinds of challenges. And the first one is how to measure inflation. This is from the Atlanta Fed. And you can see on this table, this is done monthly in the US, 1, 2, 3, 4, 5, 6, 9 possible ways to measure inflation. 9. We can't tell the average person that this is really how to measure inflation. In the US, most people do have an idea of what the consumer price index is, the CPI. The National Bank of Ukraine has a similar measurement of prices, and it's the key price level measurement, price level inflation measurement. So you can see CPI at the top with core, so less food and energy. But there are all kinds of other, we spend a lot of time trying to figure out a better way to measure prices because none of them are perfect. But there's several ways to change the CPI. So for instance, there's a median CPI. There's a trimmed mean CPI. That means getting rid of the outliers from the prices that are in the CPI basket of goods, getting rid of the outliers and trimming that to get a nicer looking mean. There's a sticky CPI because we know in the world, some prices are very sticky, don't change frequently. Some prices are very, very flexible, like gasoline prices. They change all the time. So you can even trim off, if you will, the flexible prices and see what the sticky prices are doing. See if those are actually moving. Now, to be fair, so the most important prices that we use in the United States as a guide to what's happening to inflation, we use the first one, core CPI, and we also use core PCE. So PCE is the personal consumer expenditure price index. The biggest difference between the two of these, I mean, have you learned about these two measures? Anybody in the room? I can tell you, okay, so Maria does know. Maria's had a lot of monetary policy experience, I see. Great. The key difference is just the goods that are considered in the calculation of CPI versus PCE. So these are just prices of these goods and services. The goods in the CPI, the basket of goods is a small basket, relatively small, maybe 200, about 200 goods. Those prices are used to calculate the CPI. This basket of goods is trying to reflect the typical urban household set of goods that would be purchased in the United States. And they just collect price data on those goods, the same basket of goods every month. The PCE price index is actually prices of all of the goods and services that would be purchased as part of consumption. So it's a much bigger basket, if you will, and it accomplishes a few things by looking at that larger basket. So the Fed prefers PCE measurement as a measurement of inflation. The government prefers the CPI. So they use two different measures. The CPI is used to adjust pension payments to our elderly in the US. So once a year, pension payments are adjusted, and the government uses the CPI. But the Fed will usually use the PCE. So those are, and then you see lots of other possible ways of measuring inflation. I will say, as a teacher of macroeconomics, that the reason those boxes are red, if you look at the key at the bottom of the slide, it says that the red color indicates that the measure of these inflation are more than a 0.5 percentage point above target. And remember, our target's 2%. So all of these numbers are in the red, right? All of them say the same thing. But they might be different, but they say the same thing. And that's what's important. So here are the two measurements that I mentioned to you, the core CPI and the core PCE. And these are if I'm going to discuss inflation with you, these are going to be the two pieces of data we might look at. And you can see in the little box, and your eyes will be better than mine, so you'll see this more clearly than me. You can see in the little box, what I've done is I've tried to show you. So we know that every 6 weeks, the Fed is getting together talking about interest rates, as is NBU. And we can see, we've been looking for signs in our key inflation data to see if inflation is stabilizing, if it's stopping the growth. And you can see that just recently, really just last month, there are some signs with both measures that inflation is slowing. And so the Fed officials are starting to give speeches in the US just ahead of the next meeting that's coming up, starting to give speeches telling the public that we think that while they're still going to raise interest rates, because inflation is still above the 2% target, that their expectation is the rate increases will be slower. So that's why, if you see that in the little tiny panel of data, you can see inflation does look like it's leveling. And I know some of you in the room are looking at this going, oh, that's not very exciting. That's only, 4, 5, 6% inflation. That's the NBU's target, right? But you can also see historically how different that is from what we've experienced. We've been very fortunate to live in a world of stable prices. That's not been true, of course, in Ukraine. But I will say that I think Ukraine is better suited to handle and to think about inflation. And we'll look at that in the research that's been done as well. So that was a way to measure inflation. Here's some discussion of the sources. Where is inflation coming from? So this is kind of a textbook discussion of cost push inflation versus demand pull. And have you learned about these types of inflation before in a class, probably? Again, a quick show of hands, if you don't mind. Have you learned to think about where inflation is coming from? These two sources. Thank you, Maria. I appreciate it. She's not afraid to tell me, yes, we have, even if nobody else has raised their hands. I appreciate that. So when I teach this, I think about the types of inflation because, of course, the Fed, the monetary policymakers, can affect demand pull inflation. They can have an effect directly on the demand side of the economy, but they have a harder time doing anything about cost push inflation. most of the inflation that the US had, if I go back a slide, so you can see our significant inflationary periods in the mid 70s, early 80s, a little bit in the 90s, but it's not even worth talking about, quite frankly. But the 70s and 80s, when we had this experience, this is our history. These were supply side, exclusively only supply side generated. So it was extremely costly for the US to try to bring that inflation down. Because as Maria said earlier, we had to raise interest rates to levels that you see now. Actually, you have very high interest rates. We had for the US, we had interest rates between 15 and 20% during this time period, and we had to accelerate. We had to have very high interest rates to even try to think about bringing those inflation rates down, and it was very costly to the economy. We lost many, many jobs. Those were our past experiences. Most of them have been cost push. What about today? So I don't even have a simple slide for today, right? We won't have a simple slide for Ukrainian inflationary pressures either. We have supply side forces. So we're still recovering from COVID and the supply chain pressures there. We have the spillover effects from high energy and food prices. So these affect other prices in the economy, even if our inflation measures are core and we try to get out the food and energy pressures. They're really showing up elsewhere in other prices. You know, like the price of an automobile, right? The price of an automobile has to be reflecting a new price. Buying a new car today has to reflect in part how much it costs to build it, the energy costs. So they're in the price of the automobile, even if the price of gasoline isn't in our price level measurements. So that's what I mean by spillover effects. You can't completely get energy out of the story. And of course, that's true in Ukraine and in Europe, as more so true in Europe. I put this in there for the microeconomists in the room. We do have, firms' ability with market power to pass on those higher costs that they're experiencing to consumers. So the less competitive the economy, the more we're going to see inflationary pressures just because firms can. There are accusations. I haven't seen research to prove this, but there are accusations in the US that because we have industries with firms with market power, that lots of firms are making high profits today, despite inflation, despite the economy not doing as well as it could be. So why are they doing this just to take advantage of inflation and consumers? Because that's hurting, of course, the everyday person in the economy. It's worth looking to see if there's research on this, to see if this is proven or if it's just something people talk about. There is also pressure in our labor markets. So we'll talk a little bit about our labor market because it's doing something very unusual, very contrary to the Phillips curve, again, contrary to this negative relationship between inflation and unemployment. So if you have to pay higher wages, you have to increase prices to pay higher wages. There's pressure on the labor market side. And our housing market is a very important component of price level measurements. So people spend in the CPI, about 40% of the increase in the CPI is due to housing. So we spend a lot of money individually. Individual households spend a lot of money on lodging or shelter. Sometimes it's known as. And we have very tight supply of housing. So that comes from the supply side. We've had a lot of movement of people and changing of work conditions. So people are now wanting to move out of the cities, some places. They've moved out of the cities. They've moved into bigger houses because now they can work remote. And this creates also demand side pressures on the housing market. So our housing market is across the country crazy. It's just crazy. And the only thing that has slowed our housing market prices down has been increasing interest rates. So that has had that is a very direct effect in the US on slowing spending, is through housing. But we have demand side pressures as well, because during COVID, the government spent a lot of money and the Fed decreased interest rates to zero again. So we also have these demand side policy pressures that have created some of the inflationary pressures we see. And I do mention the dollar here, although I did a little research to update myself before I put this slide together. And I see that the dollar is weakening relative to where it was. So it had been very strong a month or two ago. And we also had this was a strange macro signal in October, in the third quarter of GDP growth for the US. We had kind of strong third quarter GDP growth. It was 2.1 or 2.6. I can't remember off the top of my head. GDP growth in our first estimate of third quarter, which we weren't quite expecting. And a lot of that came from exports, which is unusual. That's not normal. Normally, I wouldn't talk about exports at all for the US. They're not that important. Not compared to consumption and investment domestically. They're not that important to our GDP, but they were important to the third quarter GDP growth for the US, and that was despite having a strong dollar. So I think that around the globe, even though the dollar was expensive, the US still looked like a good deal. We were still producing. Lots of other places have really slowed, and the US is still, our labor market is still strong. We're still producing. So it's the only explanation that I have, but it was counter to economic theory, that a strong dollar we saw a boost in exports. So probably a lag, and that's not going to persist. So in the fourth quarter, for the US, we'll see exports soften again. We're confident of that. So all kinds of interesting things macroeconomically happening today. So this is a nice picture put together this is from the Federal Reserve Bank of San Francisco. They have looked at the supply and demand and unknown, ambiguous sources of inflation. And you can see the yellow area. That's the ambiguous. We don't know where a lot of inflation today is coming from. We don't know what side, whether it be supply side or demand side. You can see the ambiguous section, the yellow parts, is bigger today than it has been in the past. So less certain of where inflationary pressures are coming from. Here's our labor market. And remember, we have a dual mandate. So the Fed is constantly by the media being criticized, right? You're going to force the economy into recession by raising interest rates. You're going to throw people out of work, right? This is what our media will accuse the Fed of doing. And we would expect, as Maria had said earlier, with higher interest rates, that the economy is going to slow, and we would expect unemployment to rise, right? So what's been happening in the US? So these are some of our labor market indicators. The middle graph is our typical unemployment rate. You measure this in Ukraine, and we have the data for the EU as well. And you can see our unemployment rate is very close to pre-COVID levels, actually right at pre-COVID levels, actually 3.6, 3.7%. So very low, very, very low. That's low. You can see it, low by historical standards. I didn't go further than that, but very low unemployment. We could criticize that measure if we want to, but we'll use that policymakers use it too. The top graph is a way for us to look, and this is quarterly data, No, sorry, this is monthly data. All of this is monthly data. So pretty frequent. The top graph looks at the number of job openings, which is the top line, blue line, and the red line looks at the number of quits. So the number of people quitting on a monthly basis. And you can see that that both of these numbers were very low at the end of the Great Recession. So that's that big gray area to the left, very, very low, right? We had low job openings and very few people quitting, right? And does anybody know why quits are interesting? Why is that data, that data about quits interesting? When would you quit your job? Do you have any idea?
If you have better opportunity.
Yeah, when you have more opportunities, right? You're not going to quit your job when the economy is not doing well. Or when you personally, as a laborer, you personally are thinking the economy is not doing well, right? This is helping us to understand how people are feeling in the economy by looking at the number of people willing to quit. If you're willing to quit, you're like, well, there's plenty of things out there for me. And that's not just tomorrow. I'm going to find a job in the next couple of months, right? That's looking ahead. That's kind of a forward-looking measure. We like being forward-looking because we know everything that the Fed does today is affecting the economy in the future, not this very minute. So that's the good news. That's what is the number of quits is. That's why we think of this as a job market indicator. And the gap between them tells us about the flexibility, the tightness of the labor market. And the bigger the gap, the tighter the market is. So we're having problems. That's a really big gap. We're having problems filling every job. The number, that gap is getting narrower. It is narrowing. So the number of job openings is coming down. That quit rate is you don't see it in this data. The quit rate is, I think it just came out. I think this is October data. I do think I have a number for November, and it's a little higher. So the gap is narrowing some, but there are still 1.7 jobs out there for every single person in the US looking for a job. 1.7 per person, per single individual. It used to be there were 2 jobs for every person looking. So is this a good time to be looking for a job in the US? This is a pretty good time. That my daughter's looking for a job. I keep reminding her, this is a really good time. Try to get a job now. I don't know what 2023 will bring to us. We can look at the data. So the bottom graph is looking at wages. And these are mixed signals because real wages are actually falling if you incorporate inflation. So this is not good for workers, but it's good for firms. Firms can keep hiring if real wages are falling. So that's what that bottom, and again, we have a couple of different ways to measure wages. So I've actually presented 4 different ways to measure wages, because we have, what a manager makes versus somebody who works for minimum wage. This is not the minimum wage, right? That data is not minimum wages. Those are fixed. But it shows you that real wages are actually falling. So that still allows firms to keep hiring. So this is a good thing for the US right now while we keep tightening. But we expect this data to change. We expect labor markets the term we might use is soften. So we talked a little bit about projections. We need to look ahead to understand what the Fed thinks. And the Fed produces this. So they publish this every quarter. They are forecasts. So for those of you in the room who've done some forecasting on your own, you might know, or you might remember, that we are not very good at forecasting, a little like the weatherman. The weatherman is not very good at forecasting either. And so these are not perfect. And you can see it. This is actually published that it's not perfect, because this publication was from September. This is actually a summary of economic projections for 2022, but it's looking ahead to 23, 24, and 25, and then the longer run. And what the Fed produces is this table where they compare their projection today in September to their June projection. So they show you how wrong they were. So they say, well, what did they think was going to happen in 2022? Notice that the June projection for the median GDP, so that's the white, the second top line there in the white, the June projection, the Fed said that they thought GDP would grow in 2022 by an annual rate of 1.7%. And look at how they adjusted it in September. They're saying, no, I think really GDP in 2022 for the US is only going to grow by about 0.2%. So they adjusted, and quite a bit, right? That's quite a change. So those are they're comparing their projections. The ECB does this so we can look at their data too. Similarly, with the PCE inflation I mentioned, our unemployment rate, you can see it's expected in 2023 to be 4.4%. So it's expected to go up. It's expected at some point our economy is going to slow. Maybe GDP will grow. Projection is 2.2%. 1.2% in 2023. And these projections are coming from, if you remember, those 12 voting members of the FOMC. Each of those 12 members has their own staff that does their own model. They do their own forecasts. So this data is coming from those 12 members' forecasts. In addition, there's another set of Fed bank presidents that don't vote, but that get to participate in creating these forecasts. So we get data, we get these forecasts from all of the 12 districts. So each of the districts does their own modeling at the Federal Reserve banks in the US. By the way, they're really interesting places to get internships. Maybe you as students, if you have any interest in trying to do an internship abroad, they may have opportunities for students to come and work at our regional Fed banks and learn about monetary policy there. So you should look on their banks' websites to see what internship opportunities they have. I know they do for U.S. Students. So what else can I? Any questions about our forecast? This is what the forecast looked like. Let's see. Oh, so you can see, more importantly, most importantly maybe, is you can see the forecast for the interest rates, right? Where they think the federal funds rate is going to be. It's at the bottom of the table. We think that federal funds rate, our interest rate, won't stop growing until about 4.4%. So we still are going to increase interest rates this month, I'm sure. So they'll end at about 4.4, maybe a little lower. I think that's changed now. 2023, they still think they're forecasting interest rates to go up a little bit in 2023, but then come back down, right? Come back down in 2024 and 2025. As you can see up, if we look ahead, that the expectation is that our inflation will get closer to the 2% target by 2024 is what's being forecast right now. 2024, 2025 to actually hit the target, but 2024 for sure. So that's the way to read this data. And this is, you can get this, I have the link to it at the bottom, but you can find these projections. All of this information is publicly provided on the Fed's website. So I chose now to go to the NBU website. I've given you, I hope, a lot of background, and you feel like, oh, I know a lot about the US central bank system, and you know a lot about a little bit about the history as well. You can come to NBU's website and see a very parallel sort of story. And I think I'm correct in saying that NBU there were new laws that created a more independent central bank starting in 2015. Am I right? Does anybody know that for sure? I feel like 2015 was kind of the beginning of when the NBU started functioning like a developed country's central bank, more independent. People had more trust, perhaps. I think it was 2015, and 2015 is an important year. It was after 2014, right, for Ukraine. So 2014 was a big turning point in Ukrainian history, as well as decision making from the Ukrainian point of view, and really, you're still developing from that, but it was a very important time period for Ukraine. And I think that the National Bank embraced decision making that the Ukrainian population made in 2014, and decided that this institution needed to become more independent, more reliable, more transparent. And so when you look at their just kind of main page about monetary policy is what I chose, you can see the policy objective talking about price stability. Also, note at the bottom, it says the NBU also promotes financial stability and sustainable economic growth unless it compromises the price stability objective. So the NBU prioritizes price level stability, but also recognizes they have to consider these things that the Fed is required to consider of employment, and also financial stability. So this looks very much like the Fed. Right? These look very, very similar. And of course, you have a place to go and look on NBU's website about the exchange rate. Very important. We don't have a lot going on. You noticed in our summary of economic projections, there was nothing about the dollar, nothing at all about the exchange rate. You can see that that's a key difference for policymaking. So here's Ukrainian inflation. You know this data better than I. Although this is, I don't know where I grabbed this. This was not from the NBU doesn't have, or at least I can't find them easily, nice graphs. They don't have a Fred, which is our graphing system that the Fed has. It's lovely. So I had more trouble finding. So I picked this up very quickly. But to be frank, I wish that I had a little bit of a longer time series, because none of the students in the room, of course, were born when I was in Ukraine. But I was in Ukraine a couple of years prior to this. And I know inflation in the couple of years prior to this period was even higher than 50%, right? So when I lived in Kharkiv in 94 and 95, there was 100% inflation. It was very, very high in that period of time. But you can see there being these time periods of inflationary pressures. That's been something that Ukraine has regularly had to deal with. And again, I think 2015 was a time period. And if we were to get, let's think a little bit about this. We have to do an imaginary experiment. We have to think about this data. Look at 2015. So that looks to me like a time period where the central bank said, NBU said, we're going to target inflation. And it looks to me from the data like there was some success there. I know that there was also exchange rate policy. There were changes to the exchange rate at that time, right? All of those policies were geared towards bringing inflation down. How does that look to you? Does that look successful from the data? From 48.6% to 13.9%? That's a pretty dramatic. I have a feeling that at least some of that, my slide. Great. So I think that I'm going to give credit to the National Bank for some of the ability to bring inflation down. I'm going to give them credit. I'll ask my friends there if that was the right thing to do, to give the National Bank of Ukraine some credit for lowering inflation in that 2016, I'm pretty sure I'm right about that time frame. So I was going to say, let's do a thought experiment. Let's look at this data. I know we would to be technically correct, we'd have to look at a lot of other data, but let's just imagine looking at the data that we see there. And I think that last data point that I have there, it was a forecast from Statista of inflation for Ukraine in 2022. So it was a forecast, and it doesn't have current data. And I think it's going to be higher. I think I have another some other data from a private firm, their forecasts from Ukraine. It's going to be a little bit higher than that. Maybe they think maybe 26%, not 20. But let's use this. Imagine that. So, and this is a good imagination. Let's imagine that we can't take away the invasion from 2014, but what if we didn't have the invasion from 2022? And what if we didn't have COVID? Do you think that the central bank could have hit its target of plus or minus 5%? Looking at that data. I know it's a short time series. It's only eight years. Do you think they could have?
I think yes.
Yeah, I agree with you, Maria. I look at the data and think that was feasible. That wasn't a target that was and how do you think your economy you were suffering after 2014. There was no denying that resources were being diverted to defending Donbass, that shouldn't have been. These are things that should not have economically happened to Ukraine. But you were growing. Ukraine was growing in that time period. I don't know about unemployment, but I imagine it was coming down. And there was the beginning of looking stable. And that's what the central bank is supposed to do. That's the most important role that a central bank has, is to stabilize things. And I see it as a potential. Certainly it was a potential in this data. There's no reason to think, because the NBU is continuing to work and continuing to innovate to get through this very difficult time. There's no reason to think that after this war, the National Bank of Ukraine it will be able to serve as a well-functioning, stabilizing force in Ukraine. I have every confidence in it. I do know people who work there, and I hope that maybe some of you will consider one day to work at the National Bank, because I do think that they're doing very, very important and very good work, and they will be a reliable. I believe that they will be a reliable partner in Ukrainian development when and through the war, quite frankly, but when the war is over. So here are your sources of inflation. These are things that you know very well. Because of the war, that's largely what you're fighting now on so many different levels. You have disruptions of production and supply chains. You also have, this is from the bank's website. This is from NBU. They note very importantly something different than in the US. You have ad hoc, meaning, what's a good term in English to use? Sort of arbitrary would be a good word. Arbitrary increases in demand, or fake, not real, not substantive, increases in demand for certain goods and services. And these are things that you're needing now to survive this period that you wouldn't normally need. We don't need so many candles. We don't need so many battery-powered anything. We don't need so many generators. This is disrupting not only the supply side, but it's disrupting demand as well, because now the requirements that people have as you're working to get through the blackouts and the time periods without electricity and water, very different. And in some ways, hard to predict. And ideally not something to get used to, right? For sure. But of course, that's what it means by ad hoc increases in demand for certain goods and services. And exchange rate depreciation, and of course, worsening of consumer and business expectations. So I chose to take some communications from NBU's website to give you a little flavor for the things that they're telling the public about, that they feel is important. Their inflation report is not too long. It's just a couple of pages. So they're talking about where is their inflation coming from. And I only picked a couple of fun things just that I thought from an American point of view, I found most interesting is what did the NBU try to highlight in their report. And some of these things are written for the general public. They are not written for an economist. They are written for the everyday people to read and say, oh, look, the National Bank of Ukraine acknowledges how expensive, for example, egg prices are. So they're talking about egg prices. So this is because one of the big contributions to inflationary pressures in Ukraine is raw food prices. And so why? Well, they say, well, specifically, it's eggs. So we have, of course, destruction of poultry farms, the usual increasing of costs and supply chain disruptions in egg production, current problems with energy, so that's a spillover effect, the drop in livestock of homegrown chickens, in part because we don't have as many people there to take care of the homegrown chickens. These are important aspects of people's lives on a day-to-day, everyday basis. And you can see the National Bank, now I don't know that in their committee meeting, they're talking about egg prices and what's going on with the chickens. But in their communications, they're talking about these things to make sure that the average person in Ukraine can read this report and feel like they understand what's happening and what NBU is doing. So I found this really interesting. The other thing that I cut and paste here, two things. The moratorium on price increases for natural gas and heating. So to remind people in Ukraine that there is still a controlled set of prices that the government is trying to stabilize for you. They're not going to stabilize everything. They can't possibly do that. That would be very disruptive to markets. And they don't want to disrupt them too much because one day this is going to be over and they want markets to take back over. But they mentioned that there is a moratorium on energy prices, that's being maintained. Lastly, at the bottom, the one I liked very much was the growth in prices of vegetables, primarily those used in cooking borscht. So also a very important staple in parts of Ukraine, and something I personally like to cook. I know you all have a different recipe. That's what I should do, is I should say, in exchange for my lecture, I want every student to go and ask their mama or babushka for the borscht recipe, and I'll collect them, and then I'll try them all. So it's something that I love, and I thought it was interesting that it was in the NBU publication, so I shared it with you. Okay, so here's a forecast from ICU Ukraine. I have a friend who works for ICU in the investment company in Ukraine, and I chose to pick a forecast from a private entity rather than NBU. This was in Twitter, so I've cut and paste a few things from Twitter, and I do follow ICU and I follow the National Bank of Ukraine in social media, both in Facebook and Twitter. I don't use Instagram. My children do. I have to limit myself to some social media constraints. So you can see their inflation forecasts are quite a bit higher than the one I had on my graph. They're looking at inflation closer to 30% by the end of 2022. They're looking at, they also are, of course, going to state the exchange rate, the kurs. I know reserves are very strong, which is good. That helps the National Bank have reserves available for defending the currency. And GDP looks pretty bad, which is not surprising, but there's a good prognosis for 2023. And so that is a promising sign, and inflation coming down. So this was a forecast that I will save in my presentation. So let's look a little bit at the EU, and I'm not an EU expert. you know, there are a lot of similarities across the national banks, whether it be NBU or the Fed or the ECB in terms of publications, communications. I wanted to just pick maybe some things that are similar and some things that are different. So what they use as their main measure of inflation is something called the Harmonized Index of Consumer Prices. And they actually break out for you the components here. I copied this from Eurostat. They break out what components of their price index is attributed to energy prices, food prices, goods prices, and services prices. And I just highlight here that energy and food prices are the more global exposed prices from the inflation that the EU faces. Services are more domestically determined. So that's why if you think about how important the prices of services are, 42% of price increases for the EU come from services, and that's more domestically determined. That's more determined by their local economies as opposed to the global system. So there's they have some exposure, but probably less exposure than Ukraine has to external prices. This is just a graph looking at inflation before, so those components of inflation before COVID, and then after COVID and war, right? So these are looking at the components. And you can see from 1998 to 2019, there were price level changes for all of these components all over the place. Like, of course, energy is very volatile, right? That's the blue line. But you could see energy and food prices very volatile. So you can see them going up and going down, sort of cyclical, lots of variation, lots of variance. And then other prices, goods prices, not so variable, and not contributing much to inflation. Similarly with things like services, maybe contributing a little more because they have a bigger weight. But you can see that they're up and down. And then look at what happens as of 2019, or really 2021, at post-COVID and then post-war. All of those components of inflation, all of those components of their prices are rising, every single one of them. Some to a greater degree, of course, than others, but all of them. There's no volatility in the ups. There are no ups and downs in these prices for the last 2 years. There's just continuous growth in all of them. So we can see that really the sources of inflation, like in the US, come from all sectors. So here's the EU forecast, something very similar to what the US does. They have a professional forecast. So let's see. The top two lines for inflation are from the Survey of Professional Forecasters, and then last. So they also do a comparison. They admit in their publication that Q4's inflationary expectations was 8.3%. But last quarter, their forecast was only 7.3, so they didn't hit the forecast correct. They had to adjust that. So they have a Survey of Professional Forecasters. They also have an ECB, which is like our Fed, right? Our Fed's staff forecast. That's what I showed you from the US before. They also have two other forecasting organizations. They have something called Consensus Economics, which is probably a little like ICU, probably a private forecasting network, and another private one, Eurozone Barometer. I actually didn't look these up, so I don't know, but they have all kinds of different people doing forecasts in the EU. That might make sense. You have lots of different countries, right, involved in the ECB and decision making. So maybe more forecasts as opposed to the Fed or NBU, where we have one national bank. We don't, and one country. And then they have other. I'm trying to think if there's anything notable or interesting. When do they think inflation is going to? So they also have. They have their forecast. Their inflation target is 2%. They think that 2024, they don't forecast out to 2025, but they think they're going to hit their it's not dissimilar to the US forecasts in terms of inflation. They do have unemployment data, and you can see it's natural in Europe to have a little bit higher unemployment than in the United States, for a couple of reasons. I'm not a labor economist. We could talk about labor markets if you want, but I will leave that to a later date if you'd like. Anybody questions or interests about the EU data? I tend to, like I said, I'm not an EU expert, but I wanted to show you that the ECB does something very similar. They publish this, and they have professional forecasters as well as the bank forecast that they publish and use in their models of how the economy is doing. Okay. So the last thing I wanted to do, and I hope I have a little bit of time, and I won't go over, I promise, and I'll give you some time to ask questions, is I wanted to share with you some things I learned from a conference that I just went to a couple of weeks ago, actually, a week ago, last week, I guess, or the week before, at the National Bank of Ukraine. So they hold at least 2 conferences a year. This one, they call this a workshop, but it's really like an academic conference. And they have excellent speakers from around the world, and doing very new cutting edge research. These are speakers that get published in very well-known American journals. Some of them are Ukrainian economists, most of whom work in the United States, but they are from Ukraine. And so I went to this workshop on the 25th, and these are free, they're remote, so students can sit and listen to them too. You don't have to be a PhD economist to actually understand what they had shared. And I wanted to let you know that these things are happening. These are resources that you have at your fingertips. And when I went to the talk, I was very interested in research that they were presenting and thought I would share some of it with you. So the keynote address at the conference was given by, I'm going to see if I can pronounce it correctly, but it was Horodnichenko, who is an economist. He's in California at UC Berkeley, but of course he's Ukrainian. And a funny thing is that he went to Kyiv School of Economics, and he was accepted to that program at a time when I was somebody who interviewed students. And I don't remember if I interviewed him, and he probably will not remember if I interviewed him. It was a very long time ago, but I do remember that I do know that it was at the same time that I was an interviewer for KSE. And he's an if you have not heard him speak, he is. I would love to take a class with Horodnichenko. There are videos online. He has taped talks. You should, if you have not ever listened to him speak about economics, speak about monetary policy. He is very well spoken. He's very easy to understand, and he is very, very good at what he does. And so I felt like I needed to share some of his work with you. The first thing that he did at the conference in the keynote was to highlight how important inflation expectations are in our modeling. So this is a little more formal, although I'm not going to give you a technical discussion. I'm going to simplify things as he did, actually. So when we model in macroeconomics, we have this fundamental set of equations. So we have a Phillips curve equation that I mentioned to you before. We have an equation about consumption, an equation about investment. Think about the things that determine GDP, consumption and investment being the most important factors. We also have something that affects wealth and also affects, therefore, consumption decisions, asset prices. And we also have a central bank decision that affects the economy. So when the Fed is modeling the macroeconomy and trying to predict what to do to interest rates, how to set monetary policy. These are equations that our central banks, NBU too, are using in their macro models to try to do those forecasts that I shared with you. And Horodnichenko notes that in each of these equations, we have this inflationary expectations term. So I just took a picture of this and I shared his slide with you. In each of those red terms, notice inflationary it's not what inflation was last period that matters. It's what are our expectations? And we have to model this in order to try to make a good forecast and make a good prediction about what our key policy rate should be in the near term. So he highlights this as saying, look, if we want to use a sophisticated model for macro, we have to recognize that it's really important how we measure inflationary expectations because it enters in so many different places. So that's how he sort of started some of the points that he was going to make about he does a ton of research on understanding inflationary expectations. So I've picked just a few things that he's written about to share with you. First thing I'm going to do is remind you what the Taylor rule is. So the Taylor rule is, and this is a very simple version of it. So when I teach macro, I show my students this Taylor rule equation because the Fed probably does follow something like a Taylor rule. And in this equation here, you can see that the interest rate, the nominal interest rate, little I, depends on the how far away we are from our inflation target. The inflation target would be pi star. And it also depends on how far we are from our potential GDP target, which also has something to do with unemployment, which is y star. So and I have a couple of examples on another slide. So our interest rate, you can see that this is a setup for the dual mandate, right? That we're taking when we're thinking about what to set our nominal interest rate, little I, to, we're taking into consideration both inflation as well as deviations of output from our target. So we're taking into consideration both employment and price level. And this can be much more complicated if you like. And there's lots of things that you can set. You can estimate those coefficients. When I teach the Taylor rule, I do something like this. I don't have my students estimating. You don't need econometrics to take my macro course. We do things just numerically. You have to take econometrics for our upper level economics courses, but not macro. So you can see how the Taylor rule would be used to help figure out what our target federal funds rate should be, what our target key policy rate should be, depending on, the three examples. If inflation is above target, but our labor markets and output are doing well, then what you would set the interest rate at 5.5% if inflation was above 3%. If we have inflation where we want it to be, but we're away from full employment by 3%, maybe we have an output gap of 3%, then our target federal funds rate should be much lower, only 2.5%. And so this is the way to use the Taylor rule. And if the inflation is below target, 1%, the economy, below full employment, we really want to lower nominal interest rates to very low, like 1%. So this is the way, and the Fed does use a version of the Taylor rule to try to estimate what the optimal target range for the federal funds rate should be. Now, in these Taylor rule examples, there is implied, I'll go back to the slide earlier, there is implied an expected inflation rate, because that pi t here, these are really expectations. These are not actuals. They should be expectations. When we're trying to formulate policy for the future, that pi t variable shouldn't actually be today's inflation. It should be an expectation of what it is. So we have to think about inflationary expectations. We have to try to measure them in order to set policy in as efficient a way as we can. So this is a chart from one of Horodnichenko's recent papers published in the Journal of Economic Perspectives. And so what this chart shows you is the different forecasts that policymaker, professional forecasts. So we have a survey of professional forecasters that the Philadelphia Fed conducts, and that's the green dotted line. And those professional forecasters are paying attention to financial markets. Similarly, the red line. The red line is looking at sophisticated forecasters, sophisticated people who know economics that are in the banking sector or in the stock or in the financial sector, making forecasts. This is their job, is to pay attention to what's going on in the economy. And Horodnichenko highlights this very clearly in this chart, that professional forecasters and the Cleveland Fed's asset price markets, those we call them market participant forecasts, those are consistently different than households. So households are being asked also survey questions. These are all from survey data. Households are being asked similar questions, but households always think inflation is much higher. What they expect, inflation is much higher than the people working in financial markets, the professional forecasters. Significant, and this has been true since 2000. The other thing that Horodnichenko adds to this is that we didn't have a good survey of firms until, you can see, around 2018, I believe, is when that first firm forecast was conducted. And that's that solid black line. So the solid black line, prior to COVID, businesses were doing pretty well at predicting, almost in line with professional forecasters. And then look what happened with COVID. Firms started to say, oh, I don't think we have inflation under control. I'm really worried about what's happening to prices. And you can see firms now diverging from the professional forecasters. And we don't have a lot of data yet. I mean, this is Horodnichenko's working, this data set will get bigger and it will have much more information for him to work with. But he's very clearly noting that if we're picking one number to represent inflationary expectations and putting it into those models, we're doing something wrong. Because who's making the decisions regularly in the economy? In this group of people we're talking about, who are the decision makers that are really affecting prices? Who are they? What do you think?
It's mostly households and firms, yes. So.
Yeah, households and businesses. And their expectations, the way we're measuring them, what they're thinking and what they're reacting to are very different than what the professional forecasting models are telling us. And I will be honest, when I teach students how to measure inflationary expectations, I'm usually sharing with them the green line. I'm usually looking at the professional forecasting model, or looking at some other spreads in asset. These are things called inflation protected assets. But those are market measures. Those are not consumer and firm measures. Those are more financial market measures. So I've learned from this that I need to let students know that how we measure things is very different from firms and markets. Another piece of research that Horodnichenko was involved in, this is published in 2022 in the Journal of Political Economy, one of the top journals in the US actually, is a paper about Fed communications and their effect on household inflationary expectations. And so he acknowledges, he sees this in the data, that Fed communications can change expectations by significant magnitudes. So Horodnichenko notes Fed communication is important, right? That it can have real effects. And he argues that what he sees in his research, I don't give you a lot of details here, so you have to go read the paper, simple messages about the central bank's inflation target have implications about real interest rates that are huge compared to what we find typically found in monetary policy announcements. However, he notes, we find that the effectiveness of these measures to the public is significantly dampened when transmitted through the news media. He's noting that if we use traditional news media outlets to communicate Fed policy, that the news media, people don't listen to it. The news, you've heard the phrase many times now, fake news, right? Coined by our former president. But households are showing in the data that they are dismissive of information from the news. This means that what comes directly from the central bank matters a lot more. So those publications that I was sharing with you, even tweets and other social media presentation, the effective news, and again, you have to read the article, read this paper to find out more details. But his recommendation is if central banks want to add direct communication to the public as a policy tool, and we've talked about them doing this, they're going to have to find new ways to reach the public without relying on traditional media, traditional news outlets. They're going to have to use non-traditional sources. Another paper that was presented, so I guess I'm going to leave Horodnichenko for a little bit, was presented by a Turkish economist looking at Turkey. So what do we know about Turkey? Anybody know anything important about Turkey? So that's another good case study. Talk a little bit about Japan. What about Turkey?
High inflation, yes, and
Really high.
So many problems.
What other problems?
Is high inflation.
Anything else?
And crazy policy, monetary policy.
Exactly. Effective. This is all we need to say. It's crazy monetary policy. You feel that way. I feel that way. The Turkish economist that presented his paper feels that way too. You can see my little comment at the bottom of the slide. Yes, crazy monetary policy. Completely contrary, right? Contrary to economic theory. So look at the paper that they have written. And it's under review. I don't know at what journal, but this paper is under review. This is a working paper. It says exchange rate and inflation under weak monetary policy. Turkey verifies theory, proves that macro theory is correct and what Turkey is doing is wrong, basically. So here's the key finding. The Turkish monetary policy experiment of the past decade, stemming from a belief of the government that higher interest rates cause inflation, provides an unfortunately clean exogenous variance. We call this this is like an experiment, right? He notes that term in the policy rule. The government has mandated, so no independence, right, between Turkish government and the Central Bank of Turkey. No independence. The government is telling Turkey, the bank, you can't raise interest rates past this point. The mandate is to keep rates low, and the frequent policymaker turnover, so you change the bank president, orchestrated by the government to enforce this, led to the Taylor principle not being satisfied, that Taylor rule I shared with you, and eventually a negative coefficient on inflation in the policy rule. So in such an environment, the authors ask, was the exchange rate still what it's supposed to be, which is a random walk? The answer is no. Was inflation anchored? The answer is no. Does the standard model that we all learn in macro to explain how the macroeconomy works as best it can, right? We've said this is a hard thing to do, to model the macroeconomy. Does it do pretty well? This policy rule set, the answer to this is yes. This actual experiment supports our macro model, says high interest rates will in fact not cause inflation. It proves it. So my policy recommendation here, as well as you guys in the room, say don't do what Turkey's doing. Luckily, you have a fairly independent central bank, which is a very good thing for Ukraine. So another really interesting paper about Turkey. Inflation, this is the third paper and the last paper I'll share with you, and I'll be done, is a paper by Oleg Korenok. I don't know if I'm pronouncing he has a hard name for me to say correctly. He's at Virginia Commonwealth University. I think he might have also gone to KSE. He's a little younger than I am, though. And a couple of other economists at different institutions in the US. This is a really interesting paper. You guys, I think, are going to really like this. The authors use internet search behavior. This is a working paper that's currently under review, or the frequency of inflation mentions on Twitter. So they're scraping data from Twitter for a large set of countries to test if and where attention thresholds. So we mean paying attention to inflation. When does paying attention to inflation happen? Because in the US, we hadn't been paying attention to inflation for a very long time. Now, of course, we are. But 2 years ago, we were paying no attention to inflation. Inflation wasn't relevant for us. That's not true in Ukraine, a very different circumstance in Ukraine. So they're interested in attention thresholds. When do people start paying attention? At what level of inflation? They're looking to test this to see if we can find a degree of an inflation rate that causes people all of a sudden to start paying attention to it. And this particular graph that I'm sharing with you is for the US. And I don't remember the date. I don't remember what the time series, or again, you can go see these papers for yourself if you're interested. But this is US data. This shows, you can see it in the data, and they have more detail in their numerical analysis, that at about 3.5% and 3.55% inflation rate, there's a structural break in the data, which